Now adjust the volume control so that the sound can be heard in all parts of the room.
This is the Protect Your Assets podcast.
Mr. Sandman,
You get the idea?
bring me a dream.
It's on the internet.
Make him the cutest that I've ever seen.
Go on.
Give him two lips like
It's like no cheese I've ever
and
tasted.
tell him that his lonesome
Here's the
nights
Sandman.
are over, Sandman.
After 25 years of hard work, Frank was just laid off.
Turn on your magic beam.
Is that you? Are you worried about that? Well, if so, you're not alone. Many people in the Bay are finding themselves without a job, and they're forced to make some pretty tough decisions, like Frank. And again, if you're like Frank, you were looking at a real problem. Stay with us today as we share 5 things you need to know about leaving work today, especially if you have a 401k, 457, or a 403b. Good morning. What a beautiful day. And welcome to Protect Your Assets. People around here call me the Sandman, and that's because I help you protect more of what's yours. We're live right now in the studio, so if you have a question, maybe something's been on your mind lately, if something comes up and you want to ask me a question, what should you do? You can always email me to questions@pyaradio.com. questions@pyaradio.com. So I was just talking about Frank. You see, his wife is a longtime listener of the show, and recently Frank's employer laid him off. Many of Frank's friends have also been laid off over the last couple of months, and many are wondering what they should do. They're faced with a pretty difficult decision. Should they keep their 401k at their current employer, or should they roll it over to an IRA? What about their pension benefit and Social Security? What choices do they have with that? Well, these are some pretty tough decisions, especially when you map it out over the next, say, 20 to 25 years, and you start to look at how that's going to pay out and what kind of money we're talking about. And the last thing you want to do is make a big mistake when it comes to this, especially Frank, because Frank's worried about passing away before his wife. So what should he do? What should you do? What's the right thing to do? And how do you avoid things like taxes and penalties and bad investment choices that you live to regret? Well, you have options, and so today we're going to talk about 5 of them. 5 things you could do if you're asked to leave your job. You're going to find it only here on Protect Your Assets this morning. Now, let's get started. Well, another down week in the market. Markets are all off year to date. And investor sentiment, well, it's just shockingly low. In fact, we haven't seen numbers like this since, you remember the fall, October of 22? I certainly do. The market for reference back then was off, S&P now, off 24% in mid-October of 2022. And investor sentiment was about the same then as it is today. Now, just to give you some color, the Dow is off year to date 2.3%. For the week, it was off 1%. S&P year to date is off 5.1%. So nowhere near down 24%, but it's down and people are feeling it. NASDAQ off 10.3%. That's probably the one that's really getting people, because all those out there owning tech stocks just thinking they're going to keep going forever. You guys don't remember 2008? Come on. The dot-com bust 2000. History repeats itself. Anyway, getting back to it. The investor sentiment right now. There's a couple of surveys we look at to see what people are thinking. There's one called the AAII. This measures investors who invest in the market. It's a sentiment survey. Right now, it's showing 28.3%. This is the lowest level since October 22. What's the reason? Well, trade threats. April 2nd's coming next week. And geopolitical upheaval. Then you got the CNN Fear Greed Guide. I love that. CNN Fear and Greed Indicator. It's sitting right now at 22%. The scale, 0 to 100. The lower it goes, the worse it is. So 22 is known as extreme fear range. And then you've got something called this is people in my business, the Investors Intelligence Advisor Sentiment. This is sitting at a bull bear spread of negative 3.4. And anything negative, especially 3.4, that's extremely bearish. So there's more bears right now than bulls. And historically, this has pointed to a buying opportunity. That's right. So anyway, these are all the lowest levels we've seen since October of 22. And I thought this morning, since it's such a bright, sunny day, I might throw some sunshine on it. But I want you to be aware of the fact that the quarter is just about over. Monday will be the last trading day of the first quarter of 25. Kind of glad it's over. This has been a tough quarter. April 1st is coming right around the corner. Then we'll be entering the second quarter. And yeah, because of April 2nd coming and the trade, whatever happening, I think there'll be more volatility short term. So get ready. What about the future? What about the third and fourth quarter of this year? So let's talk about the market. Corporate profits right now, they're rising. I know they're not so great, but they're rising. And that tends to happen only when the economy is not entering a recession. And overall, when I look at the growth potential, we're looking at 10% growth. It's not bad. You know what historical average is? 6 to 7. Okay. How about unemployment? Everyone's worried about people losing jobs. No. Unemployment's low. And right now, the private sector continues to hire people. So anytime that number is above 100,000, that's good. Now, I know government layoffs. People, I'm not saying that's okay, but it's only 2% of the total employment workforce. The Fed, well, they're taking a wait-and-see approach, but they're not raising rates. That's what they've said, and they're saying they may cut 2 times this year, which historically, when the Fed does that, that's good for stocks. How about the policy agenda? Well, that's what's making everybody worried. There's a lot of fear about that, and April 2nd's coming. And do you think the administration's going to sit on that forever? Or do you think they're going to want more pro-growth, cutting more regulations, cutting more taxes? That's what they said, so let's see what they do. Last, what about credit spreads? Well, this is for high-yield bonds when you look at spreads. These are sensitive to economic growth, and these tend to provide a warning signal if there's economic trouble. Right now, that spread, it's low. So there's no red flags there. Now, is your 401k riddled with a trap or a restriction if you get laid off? You may not know about it, but you may be stuck in the proverbial jail when it comes to getting access to that money when you need it most. Find out what that's all about when we come back. You're listening to the Protect Your Assets Show. I am David Hollander, the Sandman, and we will be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to pyaevents.com and signing up for our next free event. That's pyaevents.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. This is Protect Your Assets. I am David Hollander. People around here, they call me the Sandman. And that's because I help protect more of what you work hard for. And this past week, we got a call from Frank. Actually, his wife made him do it. He got laid off. And she's been listening to the show for a long time. She said, Frank, call those guys because you need some help. And it is a fact right now. Many companies and federal employees are being laid off right now. And all these people, and maybe you're one of them, will face an important decision beyond what are you going to do next? And that is, should you roll over your retirement account? You may have a 401k, a 457 if you're a federal worker, or a 403b. And so today we're talking about 5 things you should consider before you roll over that account to a self-directed IRA. So you want to make the right decision to try and increase your chances of not triggering any taxes or penalties, and certainly make sure it lasts the rest of your life. So if you're concerned about those kind of things, well, you're at the right place. I know right now investor sentiment is very low. People are very down and out, especially that April 2nd's coming right down the road and all the tariffs. And what are they going to do to the market in general? If you missed any of that market segment, go listen to our podcast wherever you get your podcasts. I listen to Spotify. So on Spotify, just type in Protect Your Assets and you'll see market segment and you can see what's going on in the market. All right. We're talking about getting laid off and what do you do? So this past week, we had 2 clients call who said that their companies were offering them this, not a layoff, but a retirement package. And the package seemed pretty good as the companies were offering almost, get this, a year of free salary, right? It's free, and benefits. So what we did is we went ahead and we modeled the decision for each of them, and we found that this was not such a great decision. And Jerry was telling us how many of his coworkers had taken the deal and how they were wondering, now what should they do with the 401k that was left at work? You see, 401ks seem like a great idea when you're working. You may have one right now. But when we looked at these plans, specifically the 2 plans that were in this company from these other employees and Jerry's, the plans had traps in them and restrictions. And there were some caveats that weren't, I'll say, disclosed apparently properly when you had to make these decisions. So when you went to access your money after you're no longer employed there, you start to find out some of the problems. So let's talk about, first of all, some of the good news that went along with these accounts. And then we'll look at the bad news. On the good news side, they were easy to save while they were working. Everything seemed pretty easy. It came out of your paycheck automatically. You set a little percentage and went in there, got to spread it around in different things. That contribution you made, it was tax deductible, meaning you didn't see it on your W-2, and especially right now as you're getting ready to file your taxes, you're not seeing that amount you earned last year, right? It's not showing up on your W-2, and you see on there how much you contribute to your 401k. So that reduces the amount of taxes that hopefully you're going to pay April 15th. These plans, both employers offered something known as a matching contribution. And in these employees' cases, what that meant was that the employer contributed a percentage into the plan that was up to a certain amount based on how much you put into the plan. So I call that free money, because if they didn't give you that, or if you didn't contribute to the percentage they needed you to do, you just didn't get that money. If you did, it's free money. You didn't have to work any harder to get it. They just pay it to you. But in both of our clients' cases, they were not taking the full advantage of these plans, and that's because no one helped them figure out the percentage they had to get up to get the full benefit. So they missed out on some of that, we found out. It's too late now. Now let's look at some of the bad things, because while these plans are popular, there's always an inherent problem with 401ks. First of all, in this case, they relinquish control of their money until there was specific, known as, write this down, triggering events that basically grant you permission to get access to your money in the plan when you leave. Like what? Well, these had 3 triggering events that granted permission to escape, I'll call it. These are the get out of jail free cards if you like Monopoly. Remember that game? The card number 1 you want to pull. This is the first one. You leave your current employer. Well, whether you retire, quit, or laid off from your job, this is a requirement here. You have to separate from the employer. That triggers the ability to move that money out of your plan. So if you're still working there, you don't have that ability with this particular company, even though legally some companies give you that right while you still work there. Do you know that? It's called self-defined. There are some ways to self-define your benefit, even though you're still working. How about this one? This is another trigger at this company. You have to be 59 and a half or older. In this case, reaching the magic age of 59 and a half became a triggering event. So one of these employees was 57 and he was laid off. What does that mean? Well, he's stuck because he's not 59 and a half. He can't roll that until he turns 59 and a half. And the last one, well, a qualifying hardship. If your employer allows these, again, it says in the plan, this is a qualifying hardship, and they give you a list of them. There are a few life events or circumstances that just happen that allow money to be taken out of the plan, such as medical, buying a home. You can elect to use these options, but keep in mind that if you're under 59 and a half, it could be subject to a 10% penalty and tax liability if you don't return it in time. So again, that could be another qualifying event that you need to satisfy to get access to your money. Now, switching back to the earlier story, we were talking about Frank. Remember Frank? He was laid off. So Frank's now looking at a situation because now he's out of work. He saved some money. There's some money in his savings account, but certainly not enough to last 6 months. And yes, he does have a really nice big 457 plan, but he's looking at some of those triggering events that I just mentioned. And he's wondering, does he satisfy any of those? So should he leave the plan there? Well, in some cases, he might have to leave the plan. He has no choice. And in Frank's case, when we started to look at his options, this became pretty complicated, pretty technical, pretty quickly, and he didn't have a lot of choices because of the way he's built his retirement. You know, he lives in a nice area. He did really well with his mortgage. He got a very low interest rate mortgage. He had secured it for a period of time. He'd been paying down the principal. So that mortgage is really close to be paying off right now. And most of that payment that he's making right now is not interest. It's going mainly to principal. And he feels good about that. They both do, especially his wife, because she was really worried about the mortgage if something happened to his job. And him, like what she's going to do. She wants to live in that house till she dies. A lot of good memories there. The dogs need a place to run around. So she can't go live in an apartment somewhere. So this is their situation. And guess what? That seemed great while he was working. But now that he's not working and they still have to pay the mortgage and all the other expenses, they don't have a lot of cash left. And so this retirement account is just about one of the only things he has. Now, he had a life insurance policy, and he never even thought about accessing that because it was supposed to pay the mortgage off if something had happened to him while he was working. Well, now he's not working, and the mortgage is way paid down, but there's still a decent balance there. So there's other assets and other choices he can make because he's limited right now on how much he can pull out of that retirement account, you see? So again, this is what we do. We are the professionals on the field when it comes to this kind of stuff. I've been doing this for over 30 years. And I know these are complicated and technical choices, and you don't want to do this alone. But the truth is, the more that we dig into your plan, the more that we find out things that you're missing out on and the mistakes that you could make. And make it real simple today. We have this checklist. Are you ready to retire? So these are the questions Frank should have asked before he retired or was laid off. It's not too late, though, but in your case, maybe you're ahead of this. So call this number right now. Here's what we'll do. We will email out to you immediately this morning. This will take you 2.5 minutes to run through this, and you'll see if you're ready or not. Call this number right now, 866-PROTECT. You got Phil and Lucas up there right now answering the phone. They got nothing to do this morning except help you. So call this number and say, send me that checklist right now. 866-PROTECT. You know the number, 866-PROTECT, 866-776-8328. Get your free retirement checklist emailed to you right now. Open it up, take a look at it, see what I'm talking about. 866-776-8328. Call now. Coming up next, it is time. Our popular They Say segment. And you know which one I heard this week? You're going to love it. You should always roll over your 401k when you leave your job. Is that always a great decision? You can tell by the way I asked it. Stay tuned. When we get back, you'll find out the not so good answer. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to PYAevents.com and signing up for our next free event. That's PYAevents.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, and this is Protect Your Assets. After all, we're helping you protect more of what you work so hard for, particularly right now when markets are just tough. If you're just joining us, a lot of people right now, they're facing that difficult decision. Maybe they've been laid off, maybe they're leaving work, and they're wondering what should they do with their 401k, 403b, or 457. This can be one of the most difficult decisions you ever make in your entire working career, because after all, you've worked all those years saving all that money, putting it away. You've been watching it bounce around lately in the market, and all of a sudden you're asked to leave your job, and the last thing you want to do is leave your 401k with your old employer, especially if you left on bad terms. So what should you do? What's the right thing, and how do you avoid any sort of problems? Well, this morning we're talking about 5 things you need to know when you're asked to leave your job when it comes to your retirement account. So if you missed the previous segment, you can go back and check out our podcast, Protect Your Assets, anywhere you get a podcast. Now it is time, you've been waiting patiently, for one of our fan favorite parts of the show. This is our They Say segment, where we debunk common myths, half-truths, and sometimes just bad advice that they say.
Who are they? What do they know that I don't? And what are they saying this week? Here's David Hollander, the Sandman's answer.
All I know is that I don't know.
All right, I heard it this week. They say that you should always roll over your 401k to an IRA if you leave your job. Is that always true? No, it's not. Okay. So when is it not? Well, here's a situation that happened this week. One of my very intelligent, successful clients, he who shall not be named, he called me and said, Dave, I just got this incredible offer from this competing company, and they want to pay me like 8 times what I'm making right now. And I said, whoa, wait, okay, let's look at that. What's going on? Well, he has a choice as part of this package, which is he could leave his 401k at his current job, which, by the way, they won't be happy when they find out he's leaving. Okay. So do you want to leave your money there? Really? It's kind of like hostage, right? No. And he had a decent amount sitting there. We're talking about $900,000. So if he goes to the new job, he has the ability to roll that 401k to his new job. Yeah. And that might be a good decision here in this particular case. So if you start a new job or you're looking at another job because you're thinking about leaving your current job for whatever reason, does the employer, the new employer, will they let you? Because you got to ask. Don't assume anything with this kind of stuff. Ask. will you let me roll over my previous 401k to your plan? Question mark? Because that'll give you the control and maybe some additional access to it that you didn't have with your old job. And I like to consolidate things. So especially if you're going to go to a new job and you're going to make the kind of money this client of mine is going to be making, you want to be able to defer as much as you can. And they have a backdoor Roth IRA. If you missed my backdoor Roth IRA show where you can put away up to $72,000, yeah, you heard me. Wow. Then do it. Most 401ks have a wide range of investment options, but you still might be limited to the funds that are in your plan. Well, you might be able to stay with the past employer. Maybe you leave on friendly terms and you still want to leave it. Most companies will allow you to keep your plan there. You can just leave it there. And maybe it's a good deal. Maybe you don't really know. I find most people don't really realize they're paying anything for their plan because they don't look at it. They don't know what to look at. They just say, oh, it's free. It's been there all these years. I don't see any fees coming out of it. Wrong. Nothing's free. Sure, it'll keep growing tax deferred. And sure, you can keep picking those 5 funds that are there. However, be aware that if you have less than a certain amount and you leave that job, your employer may actually cash you out. This has happened where you're sitting there thinking everything's fine and a big check shows up in your mailbox and you're like, what's this about? Now it's all ordinary income to you in 2025. And maybe you're going to be looking at a big heavy tax that you weren't counting on. Consider this. According to the Bureau of Labor Statistics, the average worker who was born between 1957 and 1963 held an average of, get this, 12.3 jobs during their career. Is that you? Well, if you choose to leave your 401k at each company when you leave, this happens to us, by the way. I've seen clients come through here with us. By the end of your career, you may have so many retirement accounts that you forget about them. You laugh. You're like, oh, I'm never going to forget about that money over there. Yeah, you do. It happens all the time. You'd be surprised. I literally have people coming in and they forgot about these 3 or 4 accounts they had over there. When you add it all up, a couple $100,000, especially because the market's been growing so much. You don't want to cash all that money in either. That's a bad decision. Maybe you're thinking, well, the market's so volatile right now, I'm afraid I'm just going to cash in my 401k. That could be an option, sure. But realize that that's all going to be 100% ordinary income this year. So you're going to pay taxes on all that. Could bump you into the new tax bracket. And if you're under 59.5, add 10% on top of that. That's right. That could be a very bad decision. So right now, you need to get educated, my friend, because one of these decisions that you make could cause you and cost you big time. So here's what you can do right now. You can get a complimentary copy of this is my personal one. I designed this. This is from me. It's a retirement checklist. And it will give you the ability to make some decisions. And it's absolutely complimentary. And I'm going to give it to you now. Pick up your phone and dial this number, 866-PROTECT. 866-776-8328. Now, Phil or Lucas will answer the phone. And you say, hey, guys, Dave said I could have the retirement checklist for free. Email that to me now. They're going to ask you for your email, and then they'll shoot over a PDF, and you'll have it in your hands. Boom, just like that. 866-PROTECT. How do you avoid that tax hit when you move the 401k? Oh, I saved the best for last. It's coming up next. Keep it right here.
If you missed any of Protect Your Assets with David Hollander, all you have to do is go to pyaradio.com where you can download or listen to our latest shows for free. Just go to pyaradio.com on your computer or mobile device when it's most convenient for you. That's pyaradio.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known around here as the Sandman. And that's because I help you keep more of what's yours, particularly during these tough times when markets are bouncing around. And you can feel it with tariffs coming. There are ways still to protect yourself and save money. Moving on. Today we're talking about the 401k because maybe you're laid off. Maybe you're going to leave your job. Maybe you're going to a new job. There are tax hits that you could receive if you do something unintentionally. Let's put it that way. So today we're talking about 401ks and 5 things you need to know. We covered the 4 already. The 5th one is what's called a tax hit. And when you leave or you're laid off from your job, your 401k is all tax deferred, meaning all those dollars you put in there, all those years, no taxes have been paid on them yet. So earlier we were talking about if you take out a one lump sum and you're going to pay all ordinary income tax on that. And if you're under 59.5, there'll be an additional 10%. So you could very easily find yourself in a 50% tax bracket, easily. So be really careful about that one. And so we can help you manage all of that and guide you on the questions and the steps you need to take to make it happen. But you have to help yourself. You need my retirement checklist. Just go through it. It's real easy and it will help you figure out if you're on the right path. I'm going to go ahead and give that to you right now this morning because you've been listening. 866-PROTECT is the number to call. Go ahead and talk to Phil. Say, hey, Phil, can I get that checklist, please? He'll email it to you. 866-PROTECT is the number to call, and we'll go ahead and send that right out to you. This is a great way to get started and make sure you're on the right path. 866-PROTECT to find out. All right, so I'd like to give a big thanks to the Protect Your Assets team for putting together a great show today. My executive producer and network manager, Kevin Renfer, and all my fabulous producers back there. You got Lee. You got Dylan, you got Nick, you got Raph, and Phil. Thanks, guys. Because without my team, I'm just another pretty voice on the radio. You have been listening to the Protect Your Assets show. I am David Hollander, the Sandman. Go out and make the rest of your life the best of your life.
Investment advisory services are offered through Liberty Wealth Management, a registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The strategies mentioned are not suitable for everyone. The information expressed does not consider your specific situation or objectives and may not be appropriate for all investors. Past performance is not indicative of future results. To better understand the risk associated with investing and how it reacts to different market conditions, listeners should always consult with their qualified investment professionals, financial advisors, legal or tax specialists, and conduct their due diligence before making any financial decisions or taking any action. The legal information provided on the air is not intended to substitute for callers hiring their lawyers to advise them about personal legal matters. Investments involve risk and, unless otherwise stated, are not guaranteed. Liberty Group LLC paid for the following program, and the host's views and opinions do not represent those of the station or its ownership. California Life Agent number 048569. Persons engaging the services of one affiliate of Liberty Group LLC companies should be aware that each company is operated separately. You're listening to the Protect Your Assets Radio Network.